Hey everyone, welcome to East Daily's monthly production stream webinar for the month of February. We're very excited to be here with you coming off of the January webinar series where we talked a little bit about some of the conclusions drawn in Dirty Little Secrets. And now, as we kind of go through 26, we're going to be punctuating those predictions to see how correct we are. Always want to be grading yourself. So the theme of this month's webinar is kind of related around constraints, both production constraints, storage constraints, and maybe some constraints that individual companies are feeling themselves. So we'll broaden that theme a little bit as we go through here, but I wanted to introduce you to today's panelists. Jackson Fryer, our equities analyst specialist, is sitting to my left. Julian Renton is not here today, but that's fine. We have someone to cover the liquids portion of the show. Keelan Rumsey is here to present our views on the Permian and also Venezuelan crude. So that's very exciting. And then Ian Hemming and Maria Urdaneta are both here. Of course, Maria being our upstream queen and Ian being our nat gas analyst. So here we go. Say hi, everyone.
Hi.
All right, good deal. Okay, so I'm not going to go through what we do, but just know the general, kind of pathway that we take people is from the wellhead all the way, really to demand, to egress capacity, to to company financials in the midstream space. So, very exciting time, obviously, for our space right now. Let's get into it. All right. Rather large agenda today, but we're going to try to keep this under 30 minutes. We'll go through our usual cross commodity production update for the month of February. We're going to talk about the forgotten S. And if you can't hold on to your pants long enough to realize what this forgotten S is, I'm going to keep you waiting for a little bit longer. We'll talk about ET. And then we're going to talk about Waha prices generally. Also, the Williams strategy behind riding the tailwind of data center demand. Finally, and this is relatively new news, we'll talk about Kinetic and Wes and their acquisition plans. And then obviously Keelan's going to jump in with Permian and just what in the heck is going on in Venezuela and how that's going to impact North America primarily. So let's get into it. Maria.
Thank you, Jack. For productions, we see prices on water continue to directly impact decision making across the lower 48 operators, but overall, we think that drilling efficiencies are becoming a key driver for the 2026 production outlook. For crude oil, for 2026, we expect an average of 13.5 million barrels per day, and key basins continue to be those Texas area. Natural gas, its dry gas production is expected to average 111 BCF per day in 2026, and the Permian, Northeast, and Arglatex regions are those key sources of production. And then for NGLs, we expect 7.7 million barrels per day in 2026, and the Northeast and the Permian continue to account for most of the production that we're expecting to see over the next year.
Perfect. Okay, so flat-ish crude gains in gas and liquids. All right, excellent. And I want to remind everybody on the call that we do not forecast these in a vacuum. That's why Maria is our upstream queen. She is obviously taking input in from all of our other groups, but she has to make sure that the crude forecast runs with the dry gas forecast or the liquids forecast, right? They all come out of the same hole in the ground, and there are various constraints on all three commodities that can impact, the other commodities. So let's look at that. All right, this slide we borrowed again from last month to kind of look at that 2030 view, right? With gas being the main driver of production growth, in the lower 48, right? So you see that climbing by about 21 BCF through 2030. It's about 4% growth per year. with oil staying flat, because WTI forward curve at the moment is not doing anything to incentivize growth. However, if we were to potentially invade Iran in the next 7 to 10 days, that could be changing. I think we did see. Keelan, did we see WTI pop to like 66?
Yep, it's been settling around 66
Okay.
As of recent.
Right. So at a $62 WTI, which is what Maria is using for 26 at the moment, flat, right? Marginal growth, kind of the way the forward strip looks now through 2030. But again, any changes there, remarkable changes to price, like that might be spurred on by a potential war with a nuclear actor, will could potentially change that. So stay tuned. Like I said, hold on to your pants. All right, and then NGL production there, riding on the coattails of gas, but must make it to the water. We'll talk a little bit about that when we look at Lake Charles down the line here. So let's go over to the forgotten S in the natural gas S&D equation. And if you haven't guessed what the forgotten S is, it is storage, right? So there's a lot of words on this page, and I'm going to let you read them while I speak over them. But basically, the U.S. has a natural gas storage problem, and the main issue is that there's not enough new storage being built to basically cover demand. So proposed storage build out capacity is 266 BCF, and that's primarily, virtually all of it is along the Gulf Coast, right? 246 BCF a day of that is salt, which is highly flexible and highly sought after, especially for LNG developers, right? But by 2030, you can see this dotted line here that represents basically maintaining 108% of demand, right? The gap between the red line and the black line here is basically about 16 BCF a day short if you want to keep the same amount of storage to cover the same proportion of demand going forward. So we're not building enough new storage facilities. Overall, we're monitoring 14 projects for that 266 BCF of capacity, but it's simply not enough. Now, a lot of those are coming in service, kind of through 2028. They'll be there by 2030, but it's still not enough. Let me give you a practical example of that. One practical winter example is what we saw during Winter Storm Fern, where there was no storage for LNG capacity holders to withdraw from, or there wasn't enough. And so they took the lion's share of the drop in demand when the freeze-offs occurred, right? Now, the inverse is also true when you look at when your demand gets bottled up. So I use the example of South Central storage inventory and hurricanes, right? Now, obviously, hurricane season doesn't start for another 4 months. So, what are you talking about, you big Yahoo, right? I don't have to worry about this now, but you will have to worry about it soon. If we were to get a hurricane rolling into, say, Port Arthur, in 2026, right? The Gulf of Mexico will have about 22 BCF a day of total feed gas capacity in October 26. That leaves 7 days of cover for basically operational flexibility there. So it's just wild, like how little cover there is if demand were to be bottled up and there was nowhere for that gas to go. Either with vessel traffic suspended or facilities that are just non-operational anymore, right? By the time 2030 comes along, right, there's 37.4 BCF a day of capacity along the Gulf Coast. That's an insane amount. Given that you got about 140 BCF of wiggle room, that reduces your kind of operational chaos time ticking bomb to just 4 days. It's actually a little bit under 4 days, which is just wild. So something to think about we dodged a bullet last summer, at the end of last summer in 2025, because there were no major storms really that entered the Gulf. Can we do it in 2 years in a row? I don't think so. So, anyway, something to think about it. You heard it here first. So that's kind of our gas story for the time being. Now, speaking of the Gulf of Mexico, speaking of expanded, potentially expanded LNG capacity, right? Well, we know one that will not be expanding, and that is ET's Lake Charles facility, which it decided to walk away from Q4, right? 25. Kind of opting for more of a domestically charged strategy there, going after data centers and their power needs, exhibited through both the Hugh Brinson proposed FID pipeline and the Desert Southwest proposed FID pipeline. But Lake Charles, ET sees some optionality for this, right? You can see on the map here, we plotted it versus a bunch of fracs, right? To kind of test out its potential, as an NGL export hub. You don't have to read the words on the page. You can see the infrastructure right there. But there is some optionality to go also with crude, right? Keelan, any comments on potential crude conversion?
No, not at the moment. Other
Okay.
than maybe highlighting, if Venezuela production can kind of come online and start increasing, you could see that maybe lean more towards a crude terminal rather than an NGL.
A crude import terminal?
Correct.
Ooh, that's spicy meatball. Okay. Well, let's stay tuned on that. Obviously, we're paying attention to ET's earnings calls every quarter. But yeah, I mean, dang, I didn't even think of it as an import terminal. That is interesting. More with Keelan on Venezuelan crude in a minute. All right, Jackson. Waha, taking it on the chin from a gas price perspective. When is that going to change? What hope is there for those poor producers in the Permian?
So this has definitely been a theme we've been hitting on for a while, with the excess egress capacity coming online in the first quarter of 2027 is going to alleviate the Waha to Henry Hub and Houston Ship spread. So that'll be a very positive read-through. There's twofold for it. So first, it's a very positive read-through for the producers, as they're going to have to pay less or suffer less for that getting rid of that gas that they don't want, the associated gas. And then the other side of that is there's less upside on the marketing pipelines. So a lot of these companies use, like Kinder Morgan has KM Tejas and Texas pipelines that they use. ET has their interstate network. And all of these companies have interstate pipelines that they use to market within Texas and the Permian. So as that spread collapses, their marketing upside will actually see a lot of pressure and a lot of compression. So we've already seen companies recontract into more stable 60 to 65 cent range, but we are going to see that some downward pressure on those earnings from those interstate pipes, because they won't be able to monetize that upside.
And if you're a vertically integrated producer shipper like BP, for example, right? Then you start to see some revenue shift, maybe from the marketing department to the upstream.
Exactly. So like if you're vertically integrated, you'll see where you'll recognize that, and it'll shift absolutely. But those players that are very exposed, like a Kinetic, that are using a lot of their assets for marketing, may see some downward pressure. More on Kinetic later as well.
Gotcha. Okay. All right. Well, that is great news. I mean, you want to talk about constraints being the theme of this month's webinar. This is one that the industry has been dealing with for a long, long time. So we'll see how that develops. All right. W. Williams. We talked about this a little bit last month. What more do you have for us this month?
Yeah. So Williams recently came out in their earnings deck, and they're going all in on power. So that's their next phase of growth. That's where they're seeing almost all of their EBITDA growth. That's not just from contracts or just normal expansion projects. So Williams is spending $7 billion on power generation CapEx over the next few years here. As you can see, their CapEx by asset type is mostly generation and then pipelines as well.
So that big orange thing. That's $7 billion worth of. They're actually building the generation.
Yes. So
Dang.
they have generation assets that they were able to lock in years back, and they got very fortunate with timing of the data center demand ramp, and they're able to monetize their asset base using Transco to supply the gas for it and then generate for that Meta facility.
Wow.
So approximately in the year end of 2027, they're going to see $1.2 billion of EBITDA uplift. And then year end 2028, they're going to see annual EBITDA uplift of about $1.8 billion from these projects.
In 2 years. So, you don't quite cover your cost, but 2 years is nothing in the life of a, power plant, right?
Yes.
So, wow. Okay. Dang, that's a interesting strategy.
Mm-hmm.
All right. And then, let's get back to kinetic there, right? So this is how the pair up kind of looks, right? Like at least from a map perspective, right?
So yeah, there's been recent market chatter that Western Midstream has approached Kinetic about a potential combination or merger. So on the surface, it makes sense. Kinetic has a strong footprint in the NGL-rich Delaware Basin, as well as West, with meaningful access to Permian gas and NGL takeaway. However, the core issue isn't integration. Kinetic gathers and processes molecules, but it doesn't control the downstream export path. So in today's midstream market, valuation premiums are increasingly awarded to the companies that control the full wellhead to water chain.
Mm-hmm.
So from Western midstream perspective, tightening Waha spreads could improve their throughput across GMP systems, and combining that with Kinetic will create a 5+ BCF a day processing scale and a deeper producer roster, as shown in the heat map in the bottom left. The combined footprint would diversify counterparty exposure and strengthen basin positioning, but structurally, there's still a gap. Neither company owns export docks or has direct NGL export capability. That's where ONEOK comes in. So they stand out as a more strategic buyer on the macro side, where ONEOK is actively building out its Permian to Texas City export value chain, and acquiring Kinetic would add incremental NGL supply directly into the system, especially as they've had to buy their way into the Permian and to come on the backside of this trend here. And it would enhance their integration all the way from the Delaware to global markets. So while a West and Kinetic combination works operationally, from a long-term strategic and valuation standpoint, Kinetic fits more cleanly into ONEOK's export-driven platform.
All right, let me ask you a highly speculative question. Obviously, ONEOK. I hope they're out there listening to us, right? Could this be like a potential like Netflix, Warner Brothers pursuit of Paramount kind of situation? Like, would they get into a bidding war for this?
Kinetic is priced very high right now,
right.
And then I think a lot of people are waiting to see what happens. It's like it's hard to understand their gathering, processing, logistics segment, because we see the volumes. We can see that they're going to face a lot of compression on the marketing side as they use a lot of that segment's revenue and earnings comes from marketing the Waha to Houston Ship and Henry Hub spreads. So as that collapses, they're going to see downward pressure, even though it will bring producers back to the region.
Maria?
I also think, doing the analogy with the
Netflix and Paramount bidding war for Warner.
It's a little bit different because you also have like ET, Targa that have a market share that it's higher. Right. So like even if they merge, I don't even think it's going to be 50% of the production in the basin. So there's leverage that they could use to finalize that merging decision.
Like West and Kinetic.
Yeah.
Gives them even more leverage.
Exactly.
So like a West Kinetic ONEOK.
It will not be like they are monopolizing all the supply. Like there's still other competitors in the basin. So it's a little bit different to the analogy that
well, let me ask you a third follow-up question, right? So let's say West and Connecticut get together and they're married and they start realizing, like whatever, I hate this word, but synergies, right? Would the combination be an attractive acquisition for ET or Targa or one of the
I don't think ET or Targa will be that interested if they have the scale, and Targa is very operationally disciplined in their investments and their outlook as well, of where they're positioning themselves. I think it makes a ton of sense for ONEOK to either acquire a Kinetic or acquire the combination of West and Kinetic, just because they've had to buy their way in to the Permian and it's just a scale.
Yeah.
Like you have to compete on scale, otherwise you're going to lose market share.
Wes has assets, kind of all over the place, right? So they could lock this up into its own business unit, right?
Yeah. Another theory we've thrown around too
Yeah.
is some other third party could buy Wes and do some of the parts, sell each part off for potentially more than the individual business is worth.
Okay.
That's just a theory.
Just a theory. All right. Well, Julian comments on this stuff every week. You know how to get to your data insights and or daily notes stuff. So really great stuff. This is just, the first kind of striking M&A deal rumor of the season. So we're looking forward to fielding more of these. All right, let's close out with crude. Speaking of the Permian, Keelan, what's up with your Permian crude outlook story?
Yeah, so Permian growth is continuing, but with caution. A volatile WTI strip is reinforcing capital discipline and constraining widespread production growth. We're expecting output to rise by about 154,000 barrels per day in 2026. That's roughly a 2% growth exit to exit. But that growth is increasingly concentrated among large cap operators such as Exxon and Chevron. These two companies are guiding towards high single-digit increases, while several mid-cap names are flat to declining. So the key theme here is scale rather than broad participation. Consolidation and super major leadership are shaping the basin's next chapter.
Okay, good examples there. So SM and Civi are trying to get scale. So are Devon and Coterra.
Yep,
right?
Devon Coterra being the latest.
Yeah, and they're not, like going to become super majors, but I guess scale is good at any cost so that you can be more like our friends at Exxon and or Chevron, right?
Yep.
Okay. Cool. All right. Well, I mean, that's a good outlook, right? Exxon kind of carrying the basin there for the most part. All right. Now, Venezuela. Am I saying that correctly? Ish. Okay. Sorry. Tell me more about this development there, Keeland. In your eyes, looking. I mean, man, that poor Canadian hockey team this weekend, and now they got to deal with Venezuelan crude. Like the hits just keep on coming.
Yep, and kind of as Jack said, Venezuela, it's representing a potential downside risk, particularly for Canadian heavy crude. As Venezuela production returns to market, they will compete directly with these oil sand volumes for U.S. Gulf Coast refinery demand. This is going to create a displacement risk, not just for producers, but for midstream systems like Southern Lights, Cochin, TMX, Keystone, and of course Mainline. Execution remains uncertain, but strategically, if Venezuelan supply increases without offsetting production cuts or stronger prices, Canadian barrels face the greatest pressure. Also, something I kind of want to note is we're seeing that renewed interest in Venezuela crude, specifically with Chevron. They just announced that they're planning on importing around 300,000 barrels a day in March, and Valero joined the conversation, targeting around 220,000 barrels per day. Phillips 66 and Citgo are the newest ones to also jump on the Venezuelan train. They're expected to start imports in April.
All right. So, Keelan, if you were a betting man, what do you think the ceiling is for Venezuelan crude oil growth through the end of the year?
Through the end of the year, I think it's going to be hard to get the short-term outlook of the production kind of ramping up as quick as people would like.
Mm-hmm.
So I see kind of some minimal growth, imports kind of slowly creeping up, kind of based on these companies wanting a little more each and every month. But for long term, it's going to take a whole lot of infrastructure development in order to boost up
and maybe some political certainty.
That as well.
All right, so it's not all bad yet for the Canadians, but in 4 years from now, when the old Winter Olympics roll around again, there could be some not only concern for the hockey team, but also concern if you're a heavy crude driller in like Alberta. Okay, cool. Well, this has been great. Good conclusions there. Good call making. Thank you for rolling with us for the past roughly 25 minutes. I will not flash on these slides very long, but just know they are there. So if you download the deck, then you will have them. And of course, subscribe to our daily and weekly content. We should note on here that we have a new portal, redesigned, AI forward portal. So if you have any questions on that, just ping us. Insights at eastdaily.com. Insight at eastdaily.com. And then our individual emails are right here. So thank you for spending the time with us. We appreciate your presence, and we will be back next month.
Thank you, Jack.
Thanks, Jack.